Okay, what I have up here is a screenshot of our position in Spectra Energy. As you can see here, the ticker symbol is SEP. And this stock, as we can see here, is trading at present at 37.28. It actually dropped to around the 33 handle yesterday, which made volatility, implied volatility, shoot through the roof, and we'll show that in a few minutes. But basically our buy-in price was 38.43. We sold a call option against this. I think it was the 40 call, which you can see here is now trading for about 50 cents mid-price. And we obviously bought back that call yesterday for a profit when Spectra went through that down move. But today it's after coming back up to 37.28. So again, conditions are right because we are pretty near our buy-in price. We're just down $114 to start selling call options once more. Now I just want to tell you about the trade we have up here. When Spectra dropped to 33, we sold the put option, the 30 put option in April also, for 34 cents, because again I saw the move as a drastic overreaction to some type of news. We have thoroughly researched Spectra and we like its fundamentals. It's a strong dividend paying stock, well over 7% dividend yield, and we see it as undervalued. Both its book and sales multiples at present at this price are much lower than its historic averages. So we see Spectra definitely worth somewhere in the region of $45 to $50 a share. Now today is March the 16th. Okay, so yesterday we sold the put option. We have a buy, a good to cancel the buy order to buy back this put option for 5 cents. So that might happen today if Spectra keeps rallying. We just used the implied volatility to our advantage. Implied volatility spiked and we sold this put option once shares were down around the 33 handle, and we should be able to buy, as I've said, this put option back for 5 cents. Now a put option, the selling of a put option is very similar to the sale of a covered call, and the reason being is that they're both bullish trades, and both of them your potential profit is capped. Although on the covered call side, although you use more capital because you need to buy the stock, your profit potential is higher because you can get the full amount of the call, plus you can get also appreciation in the stock price. But I'm just going to go here now and show you this is actually the implied volatility chart, and you can see here implied volatility spiked up to, it actually went up to over 35%, which is very rare for Spectra Energy to go up to this level, and it did that basically because of the down move. Now if we go here to a week, for example, look how the volatility spiked as the shares came down. Okay, so the first message, I suppose, of this video is when you get a spike in implied volatility in a sound stock that you have researched already, you've done your due diligence, you like the stock as a long-term play to the upside, then this immediately sounds opportunity. Why? Because, well, if we go back to the year chart of implied volatility, Spectra's implied volatility has been in the region of about 20% average over the last 12 months. Okay, so once we got this huge move to the downside yesterday on the 15th of March 2018, implied volatility spiked massively, which meant that the price of the put options and the price of the call options obviously went up in price, because the market, because of the huge unexpected down move by $5-6 yesterday, which was unprecedented for Spectra, being only a $38 stock normally. Well, then the market said, well, we got to price the options higher in here because this stock is more volatile than we thought. So we started selling put options here when the stock was trading down, because, again, as I've said, it smelled of opportunity. So let's go back to the trade page, and we have Spectra here at $37.10. We're down $133 on the trade. We're up $27 on the put option that we sold yesterday. Now, my next course of action is profits will be taking on the put option. I want this to increase a little bit more to start selling a call option against our long stock position here. As we can see from the 40 call, which is dated here the 20th of April, 35 days out, the 40 call is trading probably midpoint now. It's gone down a bit, maybe 45 to 50 cents. Maybe you'll be looking to get 35 cents. It says the last trade here is 35 cents. Okay, the next thing you got to realize and take into account is Spectra announces earnings next in May, at the start of May. So selling in this cycle, which is 35 days out, makes sense, because remember, when we're selling high implied volatility like we have here, and like we have at present, we're at 31%, which is again still over 10% higher than the average in Spectra. So this should over time come down to its average, to about 20%. When you sell options up here with an IV up here, the key is to try and buy them back lower. So that's why we want to be selling lots of either covered calls or put options up here, and then buying them back as implied volatility drops down to around the 20%, which has been the average over the last 12 months. Now, as I've said, earnings is at the start of May, so this cycle will not interfere with that earnings cycle, which means that there is no reason why implied volatility should not fall. And that's basically the takeaway from this, is that we don't like selling covered calls or naked put options through earnings. Why? Well, being option sellers, we make profit when we sell high and buy the options back low and pocket the difference. It's almost impossible to be able to do that unless you get the direction of the shares going in your favor, which would be up. It's very hard to do that through an earnings cycle. So for example, if we sold this 40 call instead, which you probably get for out in June, which will be maybe 80 cent mid-price, that's not going to, well, obviously there's more time value in this, but it's not going to fall much, these prices, irrespective of how Spectra trades within the next 6 weeks or so, up until that earnings announcement at the start of May, because implied volatility will come down. I would project that it will come down because it's just way too high at the moment. It'll come down maybe until the start of April, and then as we go into earnings, you're going to get an up move again, because the market will be pricing in not a big reaction, will be pricing in robust movement in the shares post earnings. And that's how it is with all stocks. You're going to see implied volatility in all stocks before they announce earnings. You're going to see it more elevated than its average. Okay, so all the spikes here, this is probably where it announced earnings, here, every 3 months is where the stock announced its quarterly earnings. Okay, so you don't want to get caught selling naked puts or covered calls through an earnings cycle, because you're not going to get that contraction in implied volatility that you'd usually get in normal 30 to 45 day cycles. Okay, so I just see, I don't know why that error is coming up about options not being available. They certainly are. If we go back to April, okay, Spectre's after coming down here now to 36.89, and the 40 put is not liquid. It will be probably, you probably wouldn't get midpoint there now for that if you tried. But just say you wanted to sell it for 50, which I doubt. Just say we see if we can get it for 45. No, because the 40 ask has come in. I'm going to leave that there. But basically, when we get filled at 45, hopefully, as the price of Spectre goes up, the corresponding call options will go up. Then the deltas come into play big time. Now, what I like to do with the deltas is, it's something that you can put in whatever broker you're using. Just put in what deltas each trade has, because it's very important to know when to take profits, especially on covered call trades. So, as we can see here, our long deltas are 3,683 because we're holding 100 shares of stock. Once our call option gets filled, this will be a negative delta. This is a bearish trade on its own, but as we can see here, the delta is only 20% at present. So it will only be negative mainly 20-25% of this. So you're only talking maybe negative 700 deltas. So immediately when we take out that trade, the next thing we want to do is put in a good to cancelled buy order, which basically buys back this call option for 50% of the price that we sold it at. I usually put in 60%, especially when we have very high implied volatility like we do at present. I like doing that because this 40 call doesn't expire until the 20th of April. If we can get out with 50-60% of this profit, which would mean, just say we buy at 45, you will be buying it back, or sell at 45, you would be buying back at something like between 25 and 30. No, you'd be buying back at 22.5 for a 50% profit, maybe 20 or lower for a 60% profit. So yeah, if you can do that, buy back this call option quickly over a space maybe of a few days, because as I've said, that IV should contract a lot. Well, then it just makes sense. It makes sense to take profits quickly way before the option expires, which is in 35 days time. Why do I say this? Because, and this is a mistake a lot of covered call investors make, because once this goes to 20 cents, what is and just say it goes to 20 cents in the next week, even within the next week you still have another 20 48 days to go to expiration, the bones of a month, basically. Why would you hold the call option for 20 cents for another month when that's the maximum amount you can earn on top of the 20-25 cents you've made already? It just doesn't make sense. So what we would do is we sell it, we buy it back at 50-60% profit, then we would hope that this would rally again so we can sell more, and maybe we'll sell more calls within this cycle. You know, it's all about your number of occurrences, how many times you can get in and out at really good respectable profit margins like 50-60%. So that's what we would do. Again, I'm only explaining here if our shares go down. If our shares go down, the call option also goes down, which means we've sold this for 45, as I've said. If the share price goes down, then the call option will also go down. You'll be able to buy it back at a profit and buy back the call option much lower. What happens if the shares goes up? And here, if the share price goes up, again, what many covered call traders do is they wait until the 20th of April until the shares are called away at the 40 strike. And that it's irrespective if Spectra shares goes to 40, 45, 50. Most covered call traders would wait until expiration, especially if the shares are trading above 40, which would mean that the shares are called away at 40. The profit will be the difference between your cost price and the strike price plus the price of the call option that you collected at the start. So here it would be 100 for each 100 shares. It'd be $157 plus another $45. So you're just talking just over $200, $203 would be the maximum, profit potential. Okay, but here with that you can see that how covered calls are slightly more profitable than a naked put, because with the naked put the maximum you can earn is what you sold the put option at. Okay, as we can see here, the put option, the corresponding put option is, yeah, it's about between 5 and 20. It's showing 8 up here, but it's probably about 12-13 cents really. But that's the maximum you can make on a put option, is what you sell the put option for. But on the call side, you can make money obviously from the appreciation of the shares, and this is where you can make more money from covered calls than naked puts. But going back to the covered calls, and this is where the deltas come in big time. Okay, as the call option, as this goes deep in the money, so just say the shares go to 45, even 50, this call option is going to increase big time in price. Okay, but, and here is where I would differ then. Okay, I would hold the shares until expiration if the delta of my shares do not exceed or do not equal the delta of the negative delta of the call option. Okay, let me explain. Basically, as I've discussed, the maximum profit on that trade would be $203. But that $203 maximum profit can be made beforehand if the share price spikes, because it's the same principle. You're going to wait until the delta of your call option completely cancels out the long delta of your shares. When that happens, that means you can't make any more money, basically. Okay, so, you know, covered call, is a bullish trade. You want your stock to go up. And a lot of people think it's a neutral trade and it's just an income-based trade, but the latter might be true, but it's a bullish trade. It is a bullish trade as long as the deltas of your shares exceed the negative deltas of your call option. Once that situation changes, and if I need the capital, another situation has come across my desk, maybe it's still 20 days to expiration and my max profit is maxed out, well, of course I'm going to take this trade off. Again, why would I wait until the 20th of April for the shares to be called away at 40 and for the position to disappear? It just doesn't make sense when you can make your max profit well before that. So that's today's lesson. It's just a lesson on how to, be aware of implied volatility in your covered call trading. When we are dealing with a low priced underlying where we are using covered calls on, which is Spectra Energy, when implied volatility spikes, even if we are holding the shares, we will take advantage of this implied volatility and sell puts also. Yes, this does open the possibility of that put being exercised and you having to take another 100 shares of stock. But, we at times like the risk reward setups when implied volatility just gets out of control and trades well beyond what it usually trades at. And that's what happened in Spectra on the 15th of March 2018. So the big lesson would be, just when you see a spike in implied volatility like that, up to 35% in quality underlyings, it smells opportunity, and it prompts us as traders to be more aggressive, especially in sound underlyings like something like Spectra Energy, which, as I've said, pays a 7% yield, dividend yield. So just take that into account. Like, spikes in this usually only happen in stocks which just do not have the competitive advantages of something like a Spectra. Okay, so they are few and far between. So yeah, that's the takeaway from this video. I hope you got some value out of it.